good afternoon to you, and Swadika. I think you've heard a lot of presentations. We decided to keep it a little bit more interactive. I think all our esteemed colleagues today have presented and have spoken about India. I think India is the most promising country at the moment in Asia, and I think it'll continue to be the most promising for years to come. We are the third biggest startup market in the world. We have 5,000 listed companies. We have budding entrepreneurs. New sectors are being created every day. Financial inclusion, technology stack, cheapest call rates in the world, which leads to financial penetration. I think these are just some broad topics. And my two esteemed colleagues with me today will also tell you a lot more which is going on in our country of 1.3 billion people. So the most favorite question of, all investors, why should we look at the India growth story now? And, are there any structural shifts which are happening in this market? And what is, the current macroeconomic situation in India? So maybe I start with my colleague Sulabh and Ankit. Please jump in. Sure. Yeah. Sure.
Yeah. Thanks, Abhijit. Thanks for this question. So, the India story itself is exciting from a top-down and bottom-up perspective, both sides. From a top-down, if we look at it, from a growth perspective, it's one of the fastest-growing economy amongst the economies of its own size, as well as all the other global emerging market economies. In addition to that, the question which is very pertinent is what has happened in India in the last 8 to 10 years, which has propelled the country into this trajectory. So this current government has done a lot of reforms in the last 8 to 10 years, and these reforms are going to help the country not for next 3 years or 5 years, but few decades to come. Let me list out some of the reforms which we have done. The primary of them being GST, or the Goods and Services Tax, which was introduced in 2018. That reform made the economy very efficient in terms of logistics and the various taxes of different states which were there in India. Secondly, the government has pushed a lot on production or manufacturing in the country. We all know India was more about services, while China was about manufacturing. But what has happened now is with these production-linked incentives, the government is giving incentives to anyone who wants to grow manufacturing and start exports. And that has helped a lot in terms of starting production or improving manufacturing in the area of electronics, chemicals, pharmaceuticals, auto ancillary. It's all around where it is happening. Thirdly, I think they have worked a lot on the technology part in the country to make it more efficient. And the technology started with a unique identity in the country with 1.3 billion people having a unique identity number. Then that eventually leads to payments. And so now, if you want to open a bank account, it is much easier to open with this unique ID. Along with that, you can even process payments through the UPI system which the government has started. So overall, the technology part has been a great enabler. And these reforms, whatever have been done in form of GST or technology or even reducing the income tax from the peak of 30% to 25% on a corporate level, all these reforms are there for long term. Most of these go through the Act of Parliament and they cannot be changed. So this is something which we really get excited, not from a 1 year or 2 year cycle, but from a long term to come.
So just to add a couple of more points on what Sulabh has already alluded to. First and foremost, in addition to Unified Goods and Services Tax, the government has also implemented Insolvency and Bankruptcy Code. The government had done reforms on the real estate sector by, again, implementing the real estate regulatory codes and so on. In terms of manufacturing, I think it's a very, very important step which has been taken up by the government, reduction of corporate tax rates, production-linked incentive schemes, and also if I look at from a global perspective, post-COVID, we have seen supply chain reorientation happening by global corporates, and this is clearly a big beneficiary for India from a manufacturing perspective. Just to put one number into context, if I look at manufacturing share as a percentage of GDP in India, it is currently hovering at around 15%. If I go a decade back in 2012-13, the share of manufacturing was close to 17%. So in fact, the share of manufacturing has come down in the last decade or so. But the steps which the government has taken, the macro narrative, we believe that the share of manufacturing in India will be hovering around 20% plus as we move ahead in next 5 to 7 odd years.
Thank you, gentlemen. My favorite question, and the favorite question of every investor present today, valuations. Ankit, I start with you.
Sure. So obviously, Abhijit, valuation is one point which comes to discussion with every investor meeting. I would like to give valuation in two contexts. The first context is comparing India's valuation with its own historical perspective. And the second is comparing India's valuation with other emerging markets. If I look at the last 10 odd years, India has typically traded at around 19 times 1 year forward multiples. And currently, India is trading at around 18.6 times 1 year forward multiple. And these multiples should be looked into the context that companies are expected to report mid to high teens of earnings growth rate. The ROE profiles of Indian companies are much superior compared to last 5 to 7 odd years. We are looking at close to 16% ROEs for Nifty companies by March of 2025. And if I exclude energy companies, we are looking at around 17% ROE profile. So if I look at India's valuation with respect to its historical context, I will say valuations are reasonable. They are not at all expensive. Now, the second debate is India's valuation with respect to other emerging markets. I would like to concede here that India obviously is trading at a valuation which is premium to rest of the emerging market. And I believe there are valid reasons why India should continue to trade at valuations which are higher than emerging market, both from a top-down macro perspective and also from a bottom-up micro perspective. If I look at from a top-down perspective, India is a very large economy, $3.5 trillion of economic size, which makes it as the 5th largest economy in this world. By 2031, the size of the economy is expected to exceed $6 trillion. At that size, India will be the 3rd largest economy in this world. It's a large population base, 1.4 billion population, and more importantly, what has been a struggle for the rest of the world, it's a very young population. Median age of population is 28 odd years, and it's a democratic society. If I look at in contrast with some of the other emerging market countries, we see policy paralysis, authoritarian kind of regimes, and some of the other aging-related issues. If I put that into context versus India, I think from a top-down perspective, India will continue to command a premium with respect to other emerging markets. Now, the second variation into it is from a bottom-up perspective. Let's compare MSCI India benchmark with other MSCI emerging market benchmarks. First of all, in case of India, MSCI India benchmark, the proportion of public sector enterprises is much lower compared to other MSCI indices, MSCI emerging market indices. Our sectoral breakdown is much more diversified. If you look at MSCI benchmarks for certain countries, it is dominated by either commodity companies, it is dominated by either IT hardware sectors, which both are very cyclical in nature, and thereby they will definitely command a valuation which is discount to much more structural story which India represents. Also from a stock-specific level, again, MSCI India benchmark is much more diversified. If you look at benchmarks of some of the countries like Taiwan, Korea, dominated by one or two companies, TSMC typically takes a very large proportion in MSCI Taiwan benchmark. Samsung has another very large weight in Korea, whereas if you look at MSCI India index, the largest weight of single stock is close to 8.4%, which is of Reliance Industry. And finally, it boils down to numbers and numbers. If I compare MSCI India's ROEs, it is 300 to 350 basis point higher than MSCI emerging market ROEs. If I look at earnings growth rate for MSCI India, it is 12.5% higher than earnings growth rate of MSCI emerging market indices. So if I put everything into context, yes, valuations are at premium to other emerging market, but there are really valid reasons for the same. And I think investors do recognize the same, and they are willing to give India a higher premium because of its structural, long-term, sustainable growth story. Sorry, Abhijit, I took a long answer to it, but I thought it is very important to get this point across that India, both from its own historical context versus other emerging market, I think valuations are very, very reasonable.
No, absolutely. I think you made some very pertinent points. Sulabh?
Yes, so obviously I totally agree with what Ankit has mentioned, but to add to that on top, specifically from a top-down perspective, and also to answer the macro points which Abhijit has mentioned earlier, is even from an inflation perspective, when we are worried about globally what is happening, India has come down to 5% inflation rate. And that is from a peak of 7.8% a year back. While everywhere else there is an issue of inflation, India's central bank has paused for last 4 months, 3 to 4 times. And we don't expect any more hike in near future from a broader level perspective. However, obviously, if US continues to hike, the Indian central bank might need to follow from a currency perspective. But from an inflation perspective, they're absolutely comfortable. The real rates are positive in India very much. And in fact, if things go alongside as expected, we might even start seeing cut downs by second half of next year. So from inflation perspective, we are okay. Foreign exchange reserves almost near $600 billion. A peak was $630 billion, so almost all-time high, which is very important from a foreign investor who's investing into rupee because they tend to take the rupee risk. And we think with the way inflation is positioned as well as the way the foreign exchange is positioned in India, the reserves, we think rupee is in a very comfortable state. Of course, there is a risk of US rate hike, which I mentioned. But from its own perspective, rupee is in a very, very comfortable position. Thirdly, even the GSEC yields or the government security yields seem to be in a very much comfortable range-bound position driven by the inflation. So overall, if we see even from a top-down perspective, India versus a lot of other emerging markets, as I've seen a lot of speakers talk here today, there don't seem to be any worry from a domestic perspective. Yeah.
No, fantastic. So 1.3 billion people, thriving democracy, and we have general elections coming up next year. I think every astute investor is watching us as we go into elections. There are some state elections in November and some the main election next year. So portfolio managers, how are you positioning your portfolios? What is your view on the upcoming elections?
So no, that's a very pertinent question, Abhijit, we get from all the investors, and rightly so. This is something which we also, obviously as portfolio managers, look up to because the government itself has done a great job in last 10 years. So, but one thing I would like to point out is, as I mentioned earlier, that whatever reforms this government has done, majority of them have passed through the Act of Parliament and they have become laws, like GST, or even what has happened in the unique ID of everyone. So various areas what we have seen are a part and parcel of the whole economy and whole ecosystem now in the country. So for any other government to come and reverse it is almost next to impossible. Not totally impossible, but they have to go through the parliament. And also if you go back to the history of the country, we've always seen that whatever policies are formed, they continue even after government changes in the past. Things won't change that much. Maybe what might happen is the new policies might become slow if there's any change in government. But however, having said all of these things, whatever we have read is from the opinion polls that Mr. Modi and BJP has a very, very high chance of coming back into power. And of course, driven by whatever he has done, not just for the top of the pyramid, but even for the bottom of the pyramid in the country. I mean, basic necessities like if you talk to people in the villages, they were lacking basic features like clean drinking water and a covered drainage. And those are the kind of things this government has done, apart from all the big things we hear about in media and people like us talk about. Hence, I think there's a very good chance of them coming back. But in the worst case, as I mentioned, things won't change. Maybe they just slow down in near future. But in longer term, I think the story remains the same. And also the kind of earnings growth we are expecting, as even Ankit was pointing out, is very strong. It's a double-digit, mid to high teens kind of earnings growth, which will continue to drive the kind of returns we expect from this country.
So just to add 1 or 2 points on what Sulabh has already mentioned, clearly India remains a good medium to long-term story. Having said that, elections are uncertain. While consensus do expect Modi to come back to power, by any reason, if the election outcome is different from what consensus is expecting, I will certainly agree that there will be some bit of volatility in the markets, but I will again urge investors that to use and capitalize that opportunity to reorient their portfolio, to increase their allocation in India, because from a medium, longer term story, India will continue to remain up the curve from an investment perspective.
So a very rosy picture painted by both the portfolio managers. And I think the next most important question is, what are the key risks, for investors when they invest into this market?
So Abhijit, just from a risk perspective, I will again bucket the risk into 2 broad categories. The first categories are the risk which typically comes from global macro narratives. The evolving geopolitical situations in Middle East, while we don't have a very strong trade relation with some of those countries which are at conflict as of today, but there is a consequential outcome in terms of volatile oil prices. And India, as everyone would be aware, 85% of our oil requirements are met through imports. Any significant increase in oil prices, if oil prices goes beyond $100 to barrel and it remains there for an extended period of time, it will have a concern on current account deficits of India. It will have a concern on inflation, and thereby it will have some concerns from a currency volatility perspective. The second global macro risk is obviously the growth slowdown narrative which is happening across the world. While we are going and everyone is going with the base case scenario that Fed is done with respect to rate hikes, but if the Fed continues to be on its pedal in terms of increasing interest rates, and there are some policy errors as we move ahead, it can have a repercussions from a global risk-off perspective, and India being part of any other emerging market indices, it will have some impact if there is a global risk-off. Now coming to the second part of risk, which can be India-specific, clearly from a very near-term perspective, elections typically one need to be very, very closely watching forward to. We have elections which are central elections which are due in May of 2024. As I already mentioned, base case continuity. But if there is an outcome different from it, there can be a bit of a volatility or risk which person needs to keep into consideration. The second thing is, again, from a valuation perspective, while we do believe that valuation premium will sustain, I will do agree that valuations are higher versus the emerging market. Another important dimension in India, which is very important, is from a flow perspective. Typically, when I used to meet investor a decade back, people used to have a view that what if foreign investors pulls out money from Indian market? I think the question has completely flipped out today. Today, people are concerned that while we don't worry about FII inflows, if I give you just some numbers into perspective, for last 3 years, 2021, 2022, 2023, net investment by foreign investors is close to zero. They were negative, they were marginally positive in 2021. They were $17 billion negative in 2022. There are close to $15 billion positive in 2023. So if I do cumulative number for last 3 years, practically not much of an allocation has happened by foreign investor. But in the last 3 to 4 odd years, it is the domestic investor which has risen, which have increased their allocation into the Indian equity markets. So from a risk perspective, I think I will be very, very closely monitoring inflows into the domestic mutual fund industries. We are talking about close to $23, $24 billion of yearly sticky inflows into the domestic mutual funds, which are very, very important from absorbing any volatility in the market. We have been able to overcome COVID much better than what people have thought for, thanks to the inflows which has come into the domestic mutual fund industry. So that is another risk which I think someone should be very closely watching to.
So piecemeal observation, I think as a domestic asset manager in India, it's a great time for us because systematic investment plans, 25 million citizens investing every month, month on month, putting their savings into the equity market is obviously a very promising place to be for asset managers. Yeah. Sulabh, you want to add some points to what Ankit said?
Just one thing to add is on the fiscal front, which he mentioned, is India's fiscal deficit used to be typically around 4.5%, which had gone up to 6.5% during COVID, like any other country. And of course, there are elections, and government has promised a 4.5% fiscal deficit by March 26. So that's another thing which we need to keep a track of. Though on a positive side, most of the rating agencies have kept India on a positive outlook. And additionally, the good news is that India has recently been included into the JP Morgan Global Bond Indices, which is again a very positive news in terms of people's comfort on the Indian economy and the India's bond market. And also to add, that is going to lead to a lot of around $30 to $40 billion of positive inflows into the Indian market, and which obviously helps in terms of foreign exchange earnings. And we are also hearing that a couple of other indices will also include India in them, and that is going to lead to more inflows. So, I mean, of course, with the risk comes another opportunity, but however, we need to closely track even the fiscal deficit, how it plays out over the next 2 to 3 years in the country.
So just to add Sulabh's point, and I will put some context to what Sulabh has mentioned on JP Morgan bond index inclusion, we are looking at close to $26 billion of foreign buyings of Indian government bonds by May of 2025. So India will start with 1% weight in June 24, incrementally 1% getting added every month, now finally culminating into 10% maximum weight. That $25 billion number is a very, very important number, because if I put it into context of what foreign investors have bought in this year of Indian government bond, it is just $2.5 billion. When I'm talking about $25 billion, it is 10 times the foreign investors buying of Indian government bond, which has happened this year. So that number is very, very important. Another dimension, which again, just to add to Sulabh's point, if Indian government bonds get included in FTSE, in Barclays bond indices, and if the more active managers start tracking some of these benchmark indices, we are essentially looking at close to $80 to $85 billion of foreign buying of Indian government bonds cumulatively over next 5 to 6 odd years. Again, it's a very, very significant number when put into context of India, and it also gives us in India an ability to absorb high oil prices, because it gives us forex inflows, forex flows, and that also brings into consideration that India has always been a favorite equity destination for investors, with now bonds or fixed income as a category also emerging. India's relevance in the global investment community has increased, or is going to increase, both from an equity and also from a fixed income perspective.
And very good for our infrastructure spend. So the government has said we'll spend $1 trillion on infrastructure. In 2012, we started with 45 airports. Today, we are at 150 airports. Every mega city in India, which has a population of 22 to 25 million people, will have 2 airports. Again, I think the thrust on infrastructure will help us in our story in the years to come. So, gentlemen, the golden question: what is the market going to give us? If you invest in India, what do you expect in the short term and in the longer term as an investor?
So clearly, in the short-term perspective, I will say there are certain considerations which needs to be mentioned. The top of the mind recall for investors is the election outcome. But I'm very clear from a medium to longer-term perspective, markets globally and also in India will track the earnings growth rate. And if we are talking about mid to high teen kinds of earnings growth rate being delivered by Indian companies, and assuming that valuation remains where they are, we are not expecting or not giving any assumption that valuations will get re-rated, while I do believe there can be a valuation re-rating. Even without considering that, I think the investor outcome can be somewhere in that mid-teens to high teens of earnings growth rate in terms of outcome, in terms of stock returns also.
Yeah, to add to that, if you go a bit bottom up and some themes in India, which will play out both from a short to medium term perspective, I think one is a strong consumption. So India has been a big consumption driven economy, and as we know, the per capita income rises, and India nears that $2,500 marker per capita, which China achieved in 1990s. India should see that J curve which China saw. So a lot of interesting themes to play around as we have seen fashion has been mentioned here. So retail and fashion, of course, is one theme in India also, whether it's travel and tourism, whether it's even financial services to a broader extent, because they encompass a large portion of retail consumption, whether it's housing loans, auto loans, personal loans, credit card loans. So all these themes, even from a bottom-up perspective, seem very interesting to us. Manufacturing, as mentioned earlier, again, a very interesting theme which investors want to be aligned to in India. Thirdly, infrastructure, which Abhijit initially pointed out as the kind of infra growth we have seen. And that growth hasn't stopped now. We are going to continue to see this growth for next few, maybe couple of decades to come. I mean, India is building almost 15 to 18 kilometers of a road on a daily basis. They are going to increase the number of ports, airports. Even in the railway side, they are improving the quality of the railway network. India is going to see its first bullet train from the city of Mumbai to Ahmedabad very soon. So a lot of work is happening on infrastructure side. So these 2-3 sectors we think are very interesting as a theme. In addition to that, as one of our colleagues had mentioned earlier, EV in China, EV and alternate energy is again a big theme in India. And all the large vehicle companies or auto companies in India, whether it is two-wheeler or four-wheeler, are entering into EV and be successfully doing that job. Some of them are into hybrids, but majority of them are entering through EV. Even on the alternate energy side, if you look at it, companies like Reliance are going to spend $10 billion over the next 3 to 4 years to build capability in solar as well as green hydrogen. So even on the alternate energy side, we are seeing a lot of activity going on, and rightly so, because as Ankit clearly mentioned that 85% of our oil requirement is imported, and in longer term we want to reduce our requirement or reduce our need for oil in the country. So this is the best way for India to go forward, is depend more on alternate energy than depending on non-renewable energy. So I think there are various interesting things which people can look up to in short and medium term. And in fact, if you get any opportunity, any kind of a correction driven by any of the risk playing out, as we have discussed, it will be very good to get aligned your interest towards some of these names, which all of us also own quite a lot in our portfolios put together.
No, fantastic, gentlemen. I think, we've already spoken about India being the 3rd largest startup market in the world, 5,000 listed companies. both asset managers present today, and thank you to BBLAM for giving us this opportunity. I think it's a fantastic market to participate in. New sectors are being created. I think it should be a part of your allocation strategy. And I thank you again, and please enjoy the afternoon and your lovely lunch. Thank you again.
Thank you.
Thank you.